Security valuation. Enterprise value. Enterprise value is the true economic value of a company. Enterprise value equals to market value of equity share capital plus market value of preference share capital plus market value of debt plus non-controlling interest minus cash and investment. Enterprise value is the theoretical takeover price if a company were to be bought. Enterprise value provides a much more accurate takeover valuation because it includes debt in its value calculation. Why doesn't market cap properly represents a firm's value? Because it doesn't consider debt and cash reserves. Next concept, duration. Duration is the average period the money is blocked in a bond market. It is the optimum holding period. It is the base to calculate volatility. It is the average time taken by an investor to collect his or her investment. If an investor receives part of his or her investment over the time on specific intervals before maturity, then the investment will offer him the duration which would be lesser than the maturity of the instrument. Therefore, duration of a coupon carrying bond will always be less than time to its maturity. Duration is inversely proportional to interest rate. Term structure theories. This theories explains a relationship between interest rate or bond yields and different terms or maturities. Three different term structure theories. First one, unbiased expectation theory. Long-term interest rate can be used to forecast short-term interest rate in the future on the basis of rolling the sum invested for more than one period as per unbiased expectation theory. Next, liquidity preference theory. As per this theory, forward rate equals to future spot price plus liquidity premium. Liquidity premium is added to compensate them for exposure to interest rate risk. Positive slope may be a result of liquidity premium. Third theory is preferred habitat theory. As per this theory, premiums are related to supply and demand for the funds at various maturities, not the term to maturity, and hence this theory can be used to explain almost any yield curve shape. Next concept is bond immunization. At immunization, duration equals to investor's time horizon. Interest rate is inversely proportional to bond price. Interest rate is directly proportional to reinvestment rate. Price of a bond is subject to two types of risks. First one, bond price risk. Second one, reinvestment rate risk. With change in interest rates, these two types of risks move in opposite direction. Through immunization process, selection of bonds shall be in such a manner that the effect of these two types of risks shall offset each other. Two types of risks includes bond price risk and reinvestment rate risk. Maintaining an immunized portfolio means rebalancing the portfolio's average duration every time interest changes so that the average duration continues to equal the investor's time horizon.